everything that took place the past week, where we're at in the market, and what we need to be paying attention to this week. And as a hodler, as a day trader, these are all fundamental factors that we need to be paying attention to as the market conditions start to change and evolve so that way we can react properly. So let's just go over, if you guys didn't pull these up in the chat, I sent them in almost every group so that way you guys didn't miss them. Just the weekly recap from last week. This is going to play an important role as we move into this week. All right. So I'm going to go over this and then we're going to cover some technical analysis. So let's just go over this weekly recap together. Let's understand as a community what took place. Why did the market do what it did? Why was it bearish at the beginning of the week and then bullish at the end? Let's really understand these fundamentals and order flow. So last week, at the onset of the week, we observed some downward pressure in risk assets early on into the week, particularly on Monday and Tuesday, as the cryptocurrency market had reacted to the Federal Reserve perceived hawkish stance. So we'll stop right there and we'll go over to the cryptocurrency market cap just so I can show you all. Remember at the beginning of the week, last week, Monday and Tuesday, we had been anticipating a hawkish FOMC stance from the Federal Reserve during Wednesday's FOMC release. Obviously, of course, this week we're on the 12-hour time frame and the total cryptocurrency market cap was predominantly driven by the narrative surrounding geopolitical tensions and escalations in the Middle East, weighing on risk assets. We had a slight recovery the following week. And then as we headed into the beginning of last week, you can see ending last week and then the week after last week, Monday, Tuesday rollover, you can see the fundamentals, right? Why the Fed looks like they are scrambling back to a hawkish stance. This came out April 28th, 2024. Here's another fundamental piece that came out April 30th. Talking about how the extreme bond market shorts gambles on hawkish Powell pivot, right? Remember, we had been talking about how back in March, the last FOMC meeting before the most recent one, Jerome Powell had a more dovish tilt, where he reiterated to the market that there were still 3 rate cut expectations taking place this year. And then the market started to price that out because we've seen higher inflation, we've seen geopolitical tensions, stronger dollar due to upbeat data. The market started to assume that Jerome Powell, during his FOMC statement on Wednesday last week, was going to be more hawkish. And you can see the downwards pressure that had on risk assets, where we can see crypto roughly dropping down into about $204 trillion, right? So keeping that in mind, that is why at the beginning of the week, we saw downwards momentum in risk assets, where the vast majority of crypto across the board had seen a continued sell-off from previous weeks. It was because the market started to price in that the Federal Reserve meeting on Wednesday was going to be hawkish, putting more downwards pressure on risk assets and strengthening the dollar further. Sorry, excuse me, we'll continue this. This shift was attributed to concerns over rising inflation and resilient economic data, like I mentioned. However, midweek, so this is where things started to change, right? This is now we understand why at the beginning of the week, risk off market mood. Second half of the week, investors more prone to take on risk, okay? On Wednesday, midweek, we witnessed a significant recovery in risk assets with the total cryptocurrency market cap hitting a low of around $2.04 trillion before rebounding to approximately $2.3 trillion. That is a massive inflow. Billions of dollars came back into the cryptocurrency market. Why was that? It wasn't just because people randomly woke up on Wednesday and were like, oh, today I think I'm just going to put money into crypto. There's a reason why institutions and hedge funds and family offices with much more money than you and I that actually are investing in the space woke up on Wednesday and thought that it was necessary to put money back in crypto. So there were several factors to contribute to this market turnaround. First, we had the Federal Reserve Chair Jerome Powell's comments on Wednesday following the 2-day policy meetings, Monday and Tuesday, were less hawkish, keep that in mind, key vocabulary, less hawkish than anticipated. And I just showed you guys fundamental factors from Bloomberg and from other major large news reports where the market was anticipating a hawkish stance, right? Well, when the actual meeting came out and the policy release actually came out, it wasn't as hawkish as the market had anticipated. That is optimistic for risk assets. That's positive for risk assets. So despite the acknowledging persistent inflation, Powell indicated that interest rate hikes were not under serious consideration, which is also positive for risk assets, right? The market's not anticipating that the Federal Reserve is going to hike rates anytime soon, which is great. While the Fed announced a slowdown in quantitative tightening, i.e., the opposite of quantitative easing, where they're actually pumping money into the economy, starting in June, and dismissed the likelihood of imminent rate cuts. The market perceived the overall tone from Jerome Powell as dovish. Remember, you guys have a full fundamental PDF going over dovish tone and hawkish tone and the implications and effects that that has on the market. This perception stemmed from the decision to lower the monthly QT cap to $25 billion, suggesting a desire to maintain a significant portion of coupon bonds. Additionally, on Friday, this is important, and this is going to play an important role this week. So make sure that you're paying attention right now. On Friday, we also had disappointing data that emerged from the US with average hourly earnings slightly declining from previous readings of 0.3% down to 0.2%, and the non-farm payroll, or NFP, missing market expectations. Those figures came in at about 175,000 compared to previous readings of 315,000. The unemployment rate also slightly ticked higher to 3.9% from previous readings of 3.8%. These indicators signified a weakening labor market and a slight increase in the unemployment rate. Consequently, the strength of the dollar weakened, making risk assets more attractive, right? So overall, the market was fueled. Now that we can kind of just break this down, the market momentum and the recovery in risk assets was fueled by the mention that the Fed stands ready to cut rates. This is important. Should the economy significantly weaken and unemployment rises? Given the uptick in unemployment and the disappointing labor market data, investors continue to hold on to the expectations of future rate cuts. Let me show you guys this shit and how easy it is to plan. So look at this. This is a fundamental piece that came out from PIMCO, all right? And look at what they say right here. From the FOMC meeting, the Fed mentioned that it stands ready to cut rates were the economy to materially weaken and unemployment rate rises, right? Okay, so this came out on Wednesday. Keep that in the back of your mind. They mentioned to the world, to the monetary markets, the money markets, stocks, bonds, crypto, forex, that they would be willing to cut rates if the economy weakens and unemployment rates rise. Then on Friday, what did we see happen? We saw economic weakness with the average hourly earnings missing the mark, coming out at previous readings 0.3% down to 0.2%. That's a decline. We saw the non-farm employment change missed the market expectation of 238,000, coming out below previous 315,000 at 175,000. This means less people found jobs, right? This means less people, according to market expectations and previous readings, found work, found employment. And then at the same time, we had the unemployment rate increase, showing more people filed for unemployment in the month that this data reflects, right? And on Wednesday, they told the market that they would consider cutting rates if this continued to happen. So that boosted market optimism. That allowed the market, via the market downbeat data that we got on Friday, to hold on to the narrative that at some point in time, because of dwindling economic activity still happening, that the market, the Federal Reserve, eventually is going to cut rates, right? So you see the inflow come back into risk assets, right? So we can see how that reflected. Remember when the market was down here, we had a Zoom call and we had mentioned, all right, we're at this demand range. We're at $2 trillion. We were expecting a retest of $2 trillion. The question now is, do we break lower on stronger data, or do we reverse and bounce back higher to correct some of this previous downwards move based off of downbeat data and lagging labor market figures? And that's what we got, right? So now we understand why at the beginning of last week, we saw an outflow of risk assets. Midweek, you can see this is Wednesday's price action. The market bottomed out, give or take, at roughly about $2 trillion. And now we started to make our way back to the upside. So now the question is, this week, looking forward, what do we need to see continued momentum in risk assets? That means a scenario where we bottom out, coming back down into discount and going higher, or just continuing higher from where we currently stand to correct more of this previous bullish move. How do we get here? Well, we need to see more supporting fundamental factors driving sentiment for risk assets. So now let's cover that. All right. Looking ahead to this week's events, our focus on the US data front will primarily be on the Federal Reserve speakers that are scattered throughout the week and their stance, whether it be more dovish or hawkish. Currently, the market has seen a slight recovery from the downturn over the last 2 weeks. And for this momentum to continue, we will need to see continued dovish narratives from Fed speakers this week, which would fuel rate cut expectations. So if we go and we look at the data on the forefront for this week, Monday, Tuesday, and Wednesday, we have some scattered Fed speakers all throughout the week. We have FOMC member Barkin, Fed member Williams. We have FOMC member Jefferson speaking, FOMC member Cook speaking. And so a more favorable environment for risk assets this week for crypto to continue to perform well or slightly reverse from its previous downbeat weeks, we would need to see dovish comments or supporting rate cut narrative comments from these Federal Reserve speakers driving more demand for risk assets and less of a demand for dollar. That would be the most ideal scenario, right? Now, to continue this piece, I say later in the week, we will also be watching the labor market data via the unemployment claims and consumer sentiment figures, keeping in mind that last week on Wednesday, what did the Fed say? They said that if the economy weakens and unemployment rates rise, they will consider cutting rates. So that means in order to continue this rate cut narrative this week, what would we ideally like to see? To maintain sell pressure on the dollar, ideally, we would want to hear dovish to neutral comments from Fed speakers, couple that with downbeat unemployment data indicating more people filing for unemployment and consumer sentiment coming in below previous readings. Lower than forecasted or lower than previous consumer sentiment could weigh on the strength of the dollar because it signals potential what? Economic weakness, leading to investors to sell off the currency, i.e. the dollar, right? Keeping in mind that last week, they reiterated to the markets that if we see economic weakness and unemployment rates rise, that they could potentially consider cutting rates. So that means in order to see a sustained risk on market mood this week, we would want to see dovish comments from Fed speakers, higher unemployment claims, signaling that more people are filing for unemployment, which you can already see that's the projection. Give or take, it's only a slight increase, where from previous readings at 208,000, we're looking at a forecasted reading of a slight increase to 211,000. We would prefer these readings to see a further momentum in risk assets to supersede 220,000. Like if this number came out this week at like 219 to 220,000, dollar would 110% most likely, again, not guaranteed, but most likely scenario be bearish on Thursday, right? As the market grips on to the rate cut narrative due to weakening in the labor market. Then moving on into Friday, we have our consumer sentiment and our inflation expectations. All right, and we'll get into that at a later breakdown, but ideally we would want to see those figures come out downbeat below previous below previous readings and below market expectations, which we can see as of right now. Previous readings were at 77.2, and they are set to come out with a slight decline down to 76.3. All right, but now we need to prepare because we are reactive investors here. We're traders at heart, and we're not looking to marry a bias. We need to be on the precipice of reacting conversely if we see, let's talk about the opposite, hawkish comments from Fed speakers, pushing the rate cut narrative back further and strengthening in the labor market figures, along with an uptick or strength and resiliency in consumer confidence. The demand for dollar would most likely rise and continue to weigh further on risk assets if we saw that scenario play out, right? So just keep that in mind, play the opposite side just in case, understand the fundamentals and how the market would react. And we'll go over some screenshots in just 1 second. So where'd they go? Here they are. I think Nick said that he liked these, so I'm going to continue to do them for you. And hopefully it just breaks it down very bread and butter simple, right? It's super simple to understand. So again, one-sided volatility is what we're looking for. For us to see dollar bears this week continue and risk asset bulls, that means further strength in crypto, We would need to see a dovish to neutral comments from Fed speakers coupled with downbeat unemployment data, indicating more people filing for unemployment and consumer sentiment coming in below previous readings. Cut and dry, right? Very simplistic. That would give us one-sided volatility and strength to risk assets, most likely weighing further on the dollar. Again, this is not taking into consideration any black swan events or any market turmoil that we could experience, which I'll talk about in just one second. Inversely, our reactive hypothesis is if we see dollar bulls, risk asset bears caused by hawkish comments from Fed speakers, pushing rate cutbacks further, strengthening in the labor market figures. That means we see lower unemployment claims this week, signaling more people are employed, right? And we see an uptick or resilience in consumer confidence. Most likely scenario, we'd see dollar rise and we'd continue to see further sell pressure on risk assets, right? So you guys have these screenshots in the chat just to go, keep them at your desk whenever throughout the week just to be reactive, okay? All right. So now that all of that is out of the way, the last thing that I want to say just to keep in the back of your minds this week is that we need to keep an eye on other developments in crypto that could create volatility in this space, such as geopolitical escalations in the Middle East, China, or Russia, right? Any of those things driving further demand for safe haven, gold, and dollar would obviously, of course, create more outflow out of risk assets. So be on the reactive side in case there are any geopolitical tensions or escalations throughout the entirety of the week. Okay. We know what it did to risk assets the past 2 weeks. We know what it would do to risk assets moving forward. If we see freaking announcement of nuclear war, if we see increase in Middle East tensions, some crazy US announcing that they're getting involved more, like whatever the case may be, again, that could create more inflow into dollar and gold, and outflow of risk assets will be able to react to that. Okay. On the flip side, positive developments in crypto are happening. I think we have some Ripple announcements this week via the case, if I'm not mistaken. So pay attention to that and any demand that that could create for risk assets. I know that we're on the precipice of some more ETFs being approved and whatnot. So just pay attention to that and any demand that that could create. And then obviously, of course, we're on the precipice of mass adoption in digital assets, so play your cards accordingly, right? We have been bullish, higher time frame. So in my personal opinion, if the market does continue to provide discounted opportunities, we here at CYPRX will continue to take advantage of those discounted opportunities. Again, not financial advice. I know that I will be. All right. So let's just continue to remain reactive, continue to enhance our understanding of the changing market conditions as they unfold. All right. Okay. Real quick, XRP breakdown. For those of you day traders, I'm personally still going to be looking to take some day trades on XRP, give or take the fact that we had some good positions last week, some bounces from those demand ranges that we had talked about. Here you can see the screenshot from Friday, April 26th. I'll just go over this real quick, and then we'll end the macro Zoom call and we'll get into DeFi.